Should Warren Buffett sell Coca Cola after 34 years? That's my question for you. Welcome to the Valuation Masterclass case study, where you'll learn about interesting stocks and how to value them. What's interesting about Coca Cola is that Warren Buffett owns more than 9% of the company. Wow, what a holding. So, this is Andrew Stotz of the Valuation Masterclass. Let's get started. Remember, this information is for learning purposes only. This is not investment advice or a recommendation. Coca Cola is in the industrial sector, and it is a U.S. company, of course. It's an American beverage giant that conquered the world with an estimated brand value of $90 billion. In fact, I think I got that wrong. It's not in industrials, it's in consumer staples, food sector, I believe. We make a mistake every now and then. I think that's the case. I got to double check that. So 3 things to know: centralized portfolio to maintain superior profitability, leveraging revenue through organic growth and acquisitions, and a cash cow with stable and growing dividends. Let's look at some key statistics about Coca Cola. First, there's 28 analysts covering the company, and the average upside is 12%, and they have a buy recommendation. The PE ratio is 28 times. The dividend yield is 2.7. My estimate, $50, a downside of 20%, or a sell if we were having a recommendation. Now, do you want to hear a fun fact about Warren Buffett? Well, he said, if I eat 2,700 calories a day, a quarter of that is Coca-Cola. I drank at least 5 12-ounce servings. I do it every day. Ladies and gentlemen, kids, don't follow Warren Buffett on this particular thing. All right, so Warren Buffett bought Coca-Cola shares for the first time in January of 1988. My goodness, I graduated from university in 1989. Look at that share price over that time. Since then, the share price has increased by more than 2,400%. Also, he never sold a single share of Coke. That's amazing. Here's the reason why. He says no business ever failed with happy customers. Coca-Cola is selling happiness. In fact, Coca-Cola made one of the most memorable commercials ever. I'm going to play it here, and I hope that you can hear it. Oops, hold on.
I'd like to buy the world a home and furnish it with love. Grow apple trees and honey bees and sow white turtle doves. I'd like to teach the world to stay on happy, and I'd like to buy the world a what the world wants today.
I skipped around a little bit there because I wasn't sure if it's going to demonetize or get punished for showing it. But that commercial was just one of many amazing commercials that Coca-Cola has made. And in fact, one of the interesting things in that Coca-Cola commercial is they actually have a Coca-Cola bottle with the words Coca-Cola in Thai language in that particular video. So that was one of the many languages, but that's the one I spotted since I'm here in Thailand. Let's look at the revenue breakdown. This is a beverage empire. Of course, it started with Coke, but it goes all the way. You can see Costa Coffee, Smart Water, Minute Maid, Protein, all kinds of different things. Sprite, Fanta, Fresca. I remember Fresca when I was young. And let's look at the breakdown by segment and region. Here we can see North America bringing in 34%, the bottling investments bringing in 19%, and Europe, Middle East, and Africa brought in 17%, and Asia Pacific 12%, Latin America 11%. It's such distributed across the world. Now, one thing I would share with you about Coke that's kind of interesting is that I started my career in 1989, 1 year after Warren Buffett invested in Coca Cola, working for Pepsi. And I worked for Pepsi in Los Angeles. We had 2 factories that I worked in there. One was in Torrance and one was in Buena Park. We also had a third one in Riverside, but I was at those 2 plants, and that's where I started my career on the factory floor at Pepsi. So we definitely kept our eye on what was happening at Coke when I was there. What's the story? Well, centralized portfolio to maintain superior profitability. Here we can see PepsiCo and Coke, fierce competitors, side by side. Let's look at their P&Ls. Interestingly, their strategy to expand market shares differs significantly. PepsiCo has diversified its product portfolio and encompasses food and snacks. But I'm going to just grab my pen here and show you something here that's interesting. Here is Coca Cola with a total revenue of $38,655, and we've got Pepsi double that amount of revenue. But what's interesting is that Coke is generating even more profit, even with half the revenue than Pepsi is. That's a fascinating statistic. So Coca-Cola stays centralized on beverage and is rather considered as a price follower. So let's look at this. The expansion of the product lines has led to a rise in Pepsi's revenue, which is now 2 times higher than Coca-Cola. However, Coca-Cola has superior profitability, leading to a bottom line that's similar. You can see, as I just highlighted there, but if we were to look at it from a net profit margin perspective, we could see 24 to 25% versus Pepsi at about 10%. Coca-Cola is a highly profitable business. Number 2 is leveraging revenue through organic growth and acquisition. Despite Coca-Cola being such a big global brand, there's still many people who haven't consumed a product from it yet. That's the gray portion of all the people in the world that have not yet been familiar with the Coca-Cola company. To grow in emerging markets, it bets on offering affordable products. In developed countries, it's trying to premiumization, selling premium products. So acquisitions are key to reaching new customers. Basically, acquisitions allow Coca-Cola to stay up to date with market trends. And in 2021, for example, they acquired a company called Body Armor to gain market share in the sports drink segment. Both organic growth and acquisition provide a good foundation for further growth. Let's just look at that for a moment. You can see the investment activities. There's purchases of investments, and then there's acquisitions of businesses. Both of those are pretty substantial when you look at what they're spending on. Now, Coca-Cola is a cash cow. It delivered a solid annual dividend yield of 3 to 3.5% over the past few years. Given the strong cash flow generation, it doesn't seem like that's at risk. The company even has massive share buyback programs to return excess cash to shareholders. So we can see the operating cash flow more than covers the amount of dividends that the company's paying. Operating cash flow in 2021 was more than $12 billion, and the dividend paid in that period was about $7 billion. And obviously, there's also the cash that's spent on buybacks. Let's look at the forecast. Here's Analyst. Consensus is relatively bullish. You've got 28 analysts. They've got a 12% upside. They have a buy recommendation, but the upside's not huge. Analysts are predicting a stable revenue growth and a slight margin expansion, but still at a 25% margin, it's basically 4 to 5 times, let's just say 4 times as profitable as the average company in the world. Let's look at the profit and loss statement. This is the historical numbers and my forecast. Coca-Cola has a one-of-a-kind profitability, leading to a super strong bottom line. And acquisitions are an integral part of business to drive revenue forward. And you can see that in goodwill. Coca-Cola is happy with paying over fair value for investments, mainly because they know that all they have to do, if they find a new drink that's doing well, they buy the company and then they put that drink onto a Coca-Cola truck and into the Coca-Cola distribution system, and they get a huge uptick. The company uses excess cash to buy back shares, providing additional return for shareholders. high payables outstanding illustrates the bargaining power that it has over suppliers. The payables deferred is about 270 days. Strong dividend payout contributed to a solid annual 3 to 3.5% dividend yield over the past few years. So if you want to learn how to value companies like Coca Cola, join my 6-week online valuation masterclass bootcamp. You'll learn practical skills. You'll get my tools, tips, and tricks. You'll join a group of inspiring financial professionals, and you'll get a job through my network of financial industry leaders. The next boot camp is scheduled for July 25th. That's Monday. It's almost here. After that, October 10th, and then January 9th. Just join us for $797. You can scan this QR code to get this discount and learn more, or just go to valuationmasterclass.com/bootcamp. Let's look at the valuation of Coca-Cola. This is where it gets interesting. Coca-Cola is a cash flow machine, and there's no reason to assume differently in the future. Deglobalization trend could result in lower than expected revenue if there's a backlash. In fact, I agree with consensus that Coca-Cola can defend its massive margin over time. I'm just expecting a slightly lower revenue growth. I value the company by using the free cash flow of the firm and a terminal growth rate of 3%. And that gives me a free cash flow value of $50, which is a downside of 20% versus the upside of a downside of only 13% in my bullish and a downside of 26% there. Now, recently, its PE was trading 2 standard deviations higher than its long-term average. Now, I want to switch here to look at the actual model of the company. So let me just go to the Excel model that I have on Coca-Cola. Hopefully, you can see this model. And this is the value model that we use in the Valuation Masterclass. And I'm just going to go over it. Over on the right-hand side, you can see the value that's coming from the discrete period is about $20 to $25. And the value that's coming from the terminal period is another $20 to $30 for a total price of free cash flow of the firm about $49. Now, that's a really sensitive number. In fact, we could change things around a bit. Let's just say that we lower our equity risk premium to 7. That would move the value from 49 up to 55. I think that that's possible. We could see that the cost of equity at 7.8. That's definitely possible. And also, what we can look at is the terminal growth rate. The terminal growth rate is 3%. If I were to up that terminal growth rate to 4% and say they've got more growth coming, that would bring the free cash flow value up to $68, which is already, pretty attractive. So what I do want to look at, though, is that when you bring, I'm going to look down here in my cash flow section, and here's where I look at and teach my students how to use this, where we look at the contribution that's contributed by the present value of the discrete period, the present value of the fade period, and the present value of the terminal period. What's interesting is if you choose, as I just did, a terminal growth rate of 4, now what you're going to get is about 70% of the value is going to come into the terminal period. That's pretty high. Why is that high? Because you have these terminal multipliers here of 40 and 26.7. So I'm going to bring that growth rate back down to, let's say, 2%. And that's going to give a little bit more fair of a distribution. And if we come back to what I had said before, let's go back to where we were. That's 8% for the equity risk premium, which gives us a cost of equity of 8.5. That brings our value down pretty substantially. Now, I am going to bring the terminal growth rate back up to where I had it before at 3%. And that gives me about a $49, roughly $50 per share. So you can see that it's very sensitive to the terminal growth rate and the discount rate. So now let's go back to wrap up the presentation so that we can conclude. What are the risks? Well, failure to meet changing consumer behavior, lower than expected synergies from acquisitions, and deglobalization trend could benefit local brands. What's the conclusion? Coca-Cola is a fantastic brand with a massive level of profitability. Shareholders benefit from high dividends and share buybacks, though valuation might be a bit too high right now. So let's try to answer this question. Should Warren Buffett sell Coca Cola after 34 years? Well, I think one of the ways to look at this is to ask the question, if Warren Buffett was to come and look at Coca Cola today, look at its value today, would he buy it? And I would say at these high levels of PE right now, I would say it would be hard to justify kind of rushing in. But one of the big lessons that we can take away from this whole experiment and looking at Coca-Cola and looking at Warren Buffett's investing style is that it's not nearly as important to buy a stock cheap as it is to buy a great company. And that's what Warren Buffett has done. And yeah, it's amazing. And as Lee says, I can't ever imagine him selling the real thing. Yes, agreed. Don't think he's going to do it, but it would be interesting to think about whether he would come in now at this point. That is a breakdown of Coca-Cola. I hope you enjoyed it, and I hope to see you in the Valuation Masterclass.